Good afternoon, everybody. My name is Peter, and welcome to this afternoon's webinar. Before we kick off, if I could just ask the attendees if in the little chat box that is on the right-hand side of the screen, if everybody could just say hello or yes, if I could just check that everybody can hear me before I carry on. Can everybody just give me a hello or a yes? All right, thank you. I've got a yes coming through. I trust everybody can hear me. All right, let's kick off then. So, as I said, my name is Peter Hoffman. I am an associate facilitator with Informa Middle East. I have been working with Informa for about 10 years now, and I deliver various public and in-house courses for Informa, which courses are focused on various facets of business management. One of those areas is, of course, project management. And today we're going to spend a brief amount of time talking around one of the concepts within the area of financial budgeting and monitoring for projects. So what I'm going to touch on very briefly this afternoon is I'm going to talk about the use of the net present value approach in making capital investment decisions within the project environment. Then we'll touch very briefly on the internal rate of return approach in capital investment decision making. Talk a little bit around the conflict that exists between these two approaches in certain cases. And then I'll talk lastly around addressing the problem where you have unequal lives. In other words, where you have a project that has cash flows over a period of, for example, 10 years against a project that has cash flows over a period of, let's say, 15 years. And in those cases, you'll find that the calculations can give you conflicting results. So let's kick off and let's talk about the net present value approach. Also, of course, called the discounted cash flow approach. It's one of the favored approaches within the area of project management, and specifically when making decisions around whether to adopt or not adopt a given project. Now, what makes the approach the favored approach is the fact that it accounts appropriately for what we call the time value of money. And what the time value of money in essence is about, in simple terms, is saying that a dollar today is not the same value as a dollar in a year's time. Simply put, if I were to offer you the approach of saying, should I give you $1 today or should I give you $1 in 1 year from now, everybody would opt to take the $1 today, because we all know that we can take that dollar and we can invest it and earn interest on it. And if we were to earn a 5% interest, in a year's time, instead of getting only $1, we would have $1.05. Now, right in the same way, when we look at discounting future cash flows, we basically have the opposite approach. So over here, looking at the simplistic table, we have two projects, a project A and a project B, that span a period of 5 years. And in the case of project A, we have a cash outflow, which would be the investment in the project of $100,000. And across the years 1 to 5, we have cash inflows associated with that project, starting at 50,000, 40, 30, and then 20,000 in the last 2 years. And looking at the total, we can see that we have a $60,000 net cash flow, and that is in nominal terms across our 5-year period. Similarly, we have project B, which has differing cash flows with a net cash flow of 70,000. Now, if we were to focus purely on the nominal value, then obviously project B would appear to be a more suitable project based on the fact that the nominal or net present or net value is higher than project A. But if we were to apply discount rates, and in this example I'm using a mere 10% and 20% discount rate, then the factor would be that in year 0 we start with a 1. And if we were to take 1 and divide it by 1.1, which is 10%, then we would each year, by dividing by a 1.1, we would get simplistic reductions in value. So we'd go to 0.9091 and then all the way down. Similarly, if we were to discount by 20%, we would have factors based on that. And here we can see that taking project A, the $50,000 in the first year, discounted at 0.9091, equates to 45,455. And we apply that discount rate as we have in this column for the 10% down to these values, and we have a discounted value or a net present value of 27,131, as opposed to, for project B, a net present value of 23,881. And here we can see that by applying the net present value approach, project A is in fact more favorable than project B. Using the 20% discount approach, you can merely see here that project B is not a feasible project on the basis that the net present values are discounted to a negative value. Therefore, our $100,000 investment will make a negative return. As I said, the 27,000 is the more favorable, and likewise the 4,000 for project A at a discount of 20% is more favorable. Now let's move along quickly to a couple of principles around the internal rate of return. And the internal rate of return is also known as the economic rate of return or the discounted cash flow rate of return. Now you'll remember under net present value, we in essence spoke about discounted cash flows. So there is a relationship between the internal rate of return and the discounted cash flow or net present value. Now what the internal rate of return in essence is doing is it's looking at measuring and comparing the profitability, or alternatively put, the return that we get on projects that we undertake. And the higher the internal rate of return is, the more desirable the project is. So a project with an internal rate of return of 11% would be more desirable in simple terms than a project with a 9% IRR. The principle, of course, is that the IRR needs to exceed the cost of capital, or alternatively called in many entities, the hurdle rate. And what the hurdle rate is, it is the minimum acceptable rate of return that we require together with a risk premium. Now, in simple terms again, if we were to invest our money into a simple investment with a banking institution, we may achieve a 5% return. When we invest in high-risk projects, we would want a higher return than that. So we may determine that our minimum acceptable rate of return, being above what we achieve at a bank, is in this case 9%, and added to that is a risk premium. And entities really have a look at low, medium, and high-risk projects, and they add a factor for each of those. So as opposed to using the minimum rate of 9%, entity may say that for a low-risk project, the minimum return required, or the hurdle rate, is 12%. For medium risk projects, it is 15%. And for high risk projects, let us say 20%. So the principle is, when doing an internal rate of return calculation on a prospective project, if that minimum rate is not achieved using the IRR approach, then the project is not feasible. Now, the minimum average rate of return is in essence used as the discount rate in the previous calculation we did, which was the NPV. And the NPV is in essence an indicator of the value of the investment that we have in the project. So it is a dollar-based, value-based calculation. Whereas the IRR is a calculation that gives us an indication of the efficiency or the quality or the yield that we get on a project. What it's saying in simple terms, it is a percentage that we get from IRR calculation. So NPV is value, IRR is percentage. And the IRR, of course, if it is less than the hurdle rate, the project gets rejected. And if the IRR exceeds the hurdle rate, we accept the project. Now, over here, we have a very simple layout of the IRR calculation. And the IRR, in essence, is the rate of return that makes the net present value of all cash flows within a project, and that would be cash outflows and inflows, inflows being positive and outflows being negative. It takes those and it makes them all equal to 0. So where the net present value is equal to 0, the rate of return that is required to achieve the 0 value is in essence our IRR. Again, a very simple example where here we have our years, which is depicted by the N. Here we have years, and we have cash flows across the years. And here we have an investment in a project in year 0, which is today, of 123,400. You'll note it is an outflow, it is therefore negative. And we have inflows across 3 years. And by applying the IRR formula in simple terms, we take minus 123,400 plus the cash flow from year 1, which is 36,200, divided by 1 plus the rate of return to the power of 1, because we are in the first year. Likewise, the power of 2 for year 2 and 3 for year 3. And it would continue to year N based on the number of years we have. Again, very simply, the reason why we do not divide at this point over here is because this would be 1 plus R to the power of 0, because we are in year 0. Using this calculation, we get R equals to 0.0596. Alternatively put, it gives us an IRR of 5.96%. Now, where the conflict arises between net present value and internal rate of return approaches, and on the right of the slide, I have a simple graphic over here. a graphic that shows that a project, depending on the rate, the discount rate that is used, and here we can see we start at 0, going to 5, 10, and so we progress. Depending on the discount rate, two differing projects can have differing lines. So project A at a discount rate below 7.26% is a better option than project B. But here we have a cross. So this is one of the examples where we have a difference between approaches. Now, as I said, net present value is an absolute measure that gives us a dollar-based result, whereas IRR is a relative measure that gives us a rate of return as a percentage over the lifespan of our projects. Now, both of these approaches, NPV and IRR, are the most widely used tools within entities today to assess the viability of investments and projects. Both are discounting models that look at the returns in terms of the time value of money, in other words, accounting for the inflationary aspect of the business. But where the conflict arises between these two is in the first one, between independent projects. And independent projects are projects where the one project is totally independent of a second project. There is no relationship. And were we to opt for one project, we would have to not opt for the other. Therefore, there's an independence between them. Another example where we have conflict between NPV and IRR is where we have mutually exclusive projects. And mutually exclusive projects could be due to the size of the project differing. For example, we have a project that has a $1 million investment against a project with a $10 million investment. Another one would be where we have different cash flow distributions between two projects. And I'll touch on an example in my next slide. A last one, of course, is where we have projects that differ in terms of the duration. So we have an investment in project A, where we'll have cash inflows coming into the business for a 6-year period, compared to project B, where we have cash inflows for a 9-year period. And those differing durations create conflict when we look at using NPV and IRR. So here is a very nice example of the conflict that exists. Here we have at the top, we have an example of projects where we have difference in size. So we have a project of 10 million compared to a project of $1 million. We have cash inflows of 10 and 10 in year 1 and 2 for project A, and 2 and 1. Now, if we look very simply, we'll see that we have a $20 million income stream from a $10 million investment, which is double, whereas here we have triple. Now, that doesn't mean that project B is the better of the two. If we apply the discount rate of 10% in our calculations, using NPV will show a $7.4 million return on project A and a $1.6 million on project B, which obviously means 7.4 is the better of the two. But utilizing IRR shows that the rate of return on project B is much higher at 141% as opposed to only 61 in project A. Now, it's very easy to say that the NPV calculation is better for project A purely based on the fact that the size is different. But now let's take the second example where we have differing cash flow distributions. So here we have on the left, we have a $10 million project together with another 10 million. We have a $15 and a $10 million income stream or positive cash inflow in year 1 and 2 on project A, a 0 and a 30 million for project B. Again, using discount rates. And here we can see a clear example, 2 projects, both 10 million in investment, but the net present value for project A is lower than project B, whilst the rate of return or IRR calculation gives us, in this case, purely by chance, a 100% return as opposed to only a 73% return. And this is a very good example of a conflicting situation. So if a business were applying the net present value approach in decision making, they would opt for project B. Whilst if a company or entity were using the internal rate of return approach, they would opt for project A. And the question is, well, which one is actually the better of the two? Now, there are a lot of answers to that, and I'm not going to go into the detail for now, but simply put, one would possibly look at project B for the simple reason that the idea is to maximize value in the business, and hence here we can create around $3 million more than in project A. So 2 examples of conflict. I'm going to close off with talking very quickly about what we have where we have unequal lives in projects. Unequal lives, as I said, we have a project that will result in cash inflows over a period of 5 years, for example, compared to a project with cash inflows over an 8-year period. Those are unequal lives. And here, the net present value and internal rate of return approaches do not necessarily provide us with a true reflection. And it's necessary to adjust the way in which we do our calculations. And there are 2 approaches. I'm going to touch on the bottom one first, which is the equivalent annuity method. And that basically looks at calculating the annual payments that are provided by a project, in other words, the positive inflows that come from the project, as if they were annuities. And the project with the higher equivalent annual annuity is chosen. Now, outside of that, I'm not going to go into any more detail around the calculation, but I am going to touch on the first one, which is the replacement chain approach. And what the replacement chain approach looks at doing is it in essence repeats each project to create equivalent lifespans across 2 comparative projects. And then we look at calculating the net present value over the lifespan that has been adjusted by making them equivalent. And by doing that, we then choose the project with a higher net present value. So taking an example over here, we have 2 projects, project A and B. Project A with cash outflows of 10,000 in year 0 today, and 3.5 across 6 years, whereas project B only has cash inflows across a 3-year period. Now, using a discount rate of 8.4% for both project A and B, we get discounted cash flows across our 6 and 3 years, and cumulative cash flows. Cumulative is merely the -10 plus the 1.8 gives us the -8, plus the 2.9 gives us the -5.1, and so we continue. Now, if we were to apply net present value and IRR calculations to these 2 projects based on the numbers as in the table, you will notice that project A gives a higher net present value, whereas project B gives a higher rate of return. And the reason that we have this conflict is simply because of the fact that project A spans across a longer period than project B. So how do we address this? Well, very simply, the replacement chain approach takes into account the fact that we need to equalize the lives. For purposes of this example, I made it simple, a 6 and a 3 year. So to get 3 and 6 comparative, we need to duplicate project B for a further 3-year period. And then we will have both across 6. So at the end of the year 3, we will have a reinvestment into a second equivalent project, the 5, and we would duplicate the positive cash flows across the next 3 years. And by applying the 8.4% discount rate, we now discount our values and we have comparative net cash flows across a 6-year period. And by doing this and applying our net present value calculations and internal rate of return calculations, one can now see that project B is the preferred project, both from a net present value and an internal rate of return approach. So in essence, the replacement chain approach, and this was a very simplistic example, looks at equalizing the lifespans of projects so that when we apply net present value and internal rate of return calculations, we end up with comparatives that allow for more meaningful results in our calculations. Well, I'd like to say thank you to everybody. I hope that, as brief as the webinar today has been, that what I've shared with you today has been insightful and has provided you with a little bit more information and background into how one can look at evaluating projects, specifically those with differing lives. This is only one of the concepts that is covered in the course that is presented on as a public course by Informa. And the course, of course, covers a variety of evaluation methodologies and in a lot more detail than we've done here in the webinar today. So again, thank you so much for taking your time out of your day today to attend the webinar. And I'd like to welcome any questions from the attendees. If you could just type your questions into the question box that's on the right-hand side, I'd be happy to answer any questions. So there we go. I have one question coming in. And the question is, if we have a project of 7 years and another project of 3 years, how do we compare them? Well, that would relate to the example I've just used, the replacement chain approach. And that would be an example where equalizing 3 and 7 years would mean that we would have to duplicate the 7-year project 3 times to get to 21 years. And we would have to duplicate the 3-year project 7 times to get to 21 years so that both are equal. So the example I used earlier only extended project B, but where you have 2 projects where it is not as simple as just doubling up on the one, you would extend both of them to the point where they are both at equivalent or equivalently comparable lifespans. I hope that answered that question. Any more questions? I have one more question here, and the question is, can net present value be used to rank projects? Now, I accept that the concept of ranking projects implies that we would look at net present value of one project, compare it with net present value on a second project, and the higher one would rank higher than the lower NPV project. Now, in principle, that might sound like a correct answer, but it is in actual fact not correct. Net present value, as I said, merely provides us with a value-based result. And what we need to look at is we need to look further when we rank our projects, and we need to use some form of index to be able to ensure that our projects are comparable in terms of considering which one to go ahead with. I'm not going to go into the detail this afternoon. It's something that I cover in more detail in my course, but in principle, we would apply what is called the profitability index to a project, and that is an extension of our net present value calculation to allow for calculating an index. And the reason we do that is quite simply because net present value, as I said, is merely a value-based answer or result, and it doesn't account for the fact that the investments that are made in different projects are, of course, different in value. So profitability index is something that is used as an extension to address the issue of ranking when we look at projects. I hope that answered that one sufficiently. Any more questions? It would appear I have no more questions for this afternoon. So again, I'd like to say thank you very much to everybody for attending this afternoon's webinar. It's been an absolute pleasure. And I'd like to wish you a very good afternoon and evening further. Thank you very much.